Hi there, my name is Jason Ayers, CEO of the Croft Financial Group and a member of the Investment Review Committee. On behalf of the committee, thank you for taking the time to watch our Portfolio Manager's Brief for September 2019. There has been an overriding question raised during our investment committee meetings over the past several months. What's changed? And at this point, the answer continues to be a resounding nothing. The US and China went tit for tat during the month of August as both sides introduced a new round of tariffs. Economic data came in somewhat weaker than expected, and once again, the U.S. Treasury bond market flashed a recessionary signal, causing markets to slide. Despite these seemingly bearish signs, damage to both Canadian and U.S. stock markets was relatively limited. On average, stocks remained caught in a range just below the year's highs as day-to-day headlines sparked fits of buying followed by selling at the slightest sign of negativity. Sound familiar? Again, nothing's really changed. Part of the support for the stock market is coming from the expectation that the U.S. Federal Reserve will intervene to counteract the risk of a recession through their interest rate policies. All eyes were on the meeting between the global central bank leaders at Jackson Hole at the end of August. However, very little came out of this, adding to the continued uncertainty. And of course, that did not go unnoticed by Trump as he took to Twitter once again to berate the Fed's inaction with comments like, "As usual, the Fed does nothing," and "My only question is, who is the bigger enemy, Jay Powell or Chairman Xi?" So once again, this month we're left with a yield curve inversion as a predicting indicator of a possible recession. No resolution to the trade war, although markets are currently rallying based on a scheduled meeting between Trump and Xi in October. And we're left with a central banking policy in Canada, the US, and Europe that has more or less taken a wait-and-see approach, all suggesting caution. At the same time, economic indicators on average, corporate bonds, which anticipate company risk, and stocks for the most part lean towards a recession being a low probability. Our income-focused portfolios continue to remain defensive with a higher allocation to bonds and fixed income securities. We continue to buy companies with low correlations to the overall market that have proven to do well in slower economic environments, and we've been purchasing shares of these companies on dips as their share prices have become more attractive. Our option writing strategies continue to add value as we are generating income on range-bound stocks as share prices trade between support and resistance levels. The ongoing increase and decrease of market volatility also works for this approach as we're receiving a higher premium for the contracts we sell. Our growth-focused portfolios continue to remain defensive and hedged given the directional uncertainty of the overall market. We continue to buy individual companies on the dips and sell into the rallies as stock prices in general remain caught in a range. We're also writing options to enhance returns and offset portfolio volatility. Once again, in reviewing our analysis of global economic conditions and the risk of a slowdown, we have concluded that nothing has really changed. Stock prices in general continue to be caught in a range while investors wait for some defining signal supporting a direction. This further reinforces our defensive stance, continued active management, and discriminating security selection, and most importantly, patience.